Good morning. I'm Gerard Vecchio, Managing Director at MarshBerry. And today I'm here with David Paul, Principal at ALIRT Insurance Research. And we will be discussing today David's research on the third quarter financial results of the property casualty insurance industry, specifically on the commercial lines side. So first of all, David, thank you again for your continued participation in this video series. Today, I'd like to kind of set the stage by just articulating a little bit as to where I think the industry is today. We see an industry that's had lower operating income on weak underwriting results. We've seen lower investment portfolio yields because interest rates continue to go down vis-a-vis 12 months ago. Yet we see a hardening underwriting environment, even though surplus is not necessarily decreasing. So it is a bit of an anomaly where we sit today. So I was hoping, David, you could comment on why we're in the situation we are today.
Well, thank you, Gerard, for having me as always, and happy holidays to all the listeners. Your question's a good one. As we stressed in our 930, or so we kind of do a cumulative 9-month look at the U.S. property casualty industry. We wrote in our introduction that this is what Gallagher, I think, called an underwriting-driven hard market. Others have stressed a similar point, that this is a hardening market that's not caused necessarily by a dearth of capital. It's caused more by underwriters becoming disciplined, even though capital, as you state, is still relatively strong for the industry. So let's talk a little bit about what we're seeing. I don't know that I'd 100% agree that the underwriting results are poor. The industry from our work actually came in at about a 99 through 9 months. So that's pretty good historically for the industry. And again, we see this, that the industry is really trying to hold the line on underwriting income. And as you point out, I just saw a headline from Best today that talked about COVID, cats, and interest rates, right? So it's this kind of triple witching type thing. And all those are in play for sure. So we are seeing that the industry is growing its surplus. Granted, it didn't grow as much as last year. One of the things that can really drive surplus is the returns, capital gains, if you will, on unaffiliated stocks. And we did see stocks come back nicely, but maybe not to the same extent that we saw last year, which really helped push capital up. But capital is up. The underwriting results, as I stated, are decent. But what we are seeing is we're seeing a disparity between what the personal lines carriers are earning and what the commercial line carriers are earning. And that differential is growing. I think it was maybe 5 to 6 points different, as of 9 months. So we are seeing a differential. And we're seeing, as you stated, on the commercial line side, that's really where we're really seeing the push for rate, as anyone kind of writing that business knows. And I think one of the big reasons is that the underwriters are in a great period of uncertainty about these issues, about COVID, about cats, and about interest rates. And a fourth element there, of course, is this concept of social inflation, which is a reality in a number of lines, certainly some of the general liability lines and professional liability lines and others, where they don't have clarity on exactly what their losses are going to be. So it makes it difficult, of course, to reserve. It makes it difficult to price going forward. And I think that, as always, what we see is that there's always some momentum. When you get into a hardening market cycle, there's always this momentum that kind of carries you forward. And insurer managements will play this up, I think, and rightfully so. They're looking out for their own interests and their stakeholders. So they're going to continue to speak up this hard market and hopefully continue to see it going. But I think that there will, at some point, obviously this always happens, there will be a point where the profits become rich enough that other folks start to step in. And we'll just have to see other capital, I should say, and we're already starting to see that, where that will kind of put a ceiling on continued rate increases.
Well, just one follow-up question, because David, I think you put it very well in the sense that, even if, with a 99% combined ratio, the results are not bad. It's also in relation to interest rates, which are at historic lows compared to when the industry, was dealing with 10% or double-digit interest rates and had a better chance at making money in a high interest rate environment. So it is all relative as we both look back over our 30-year careers. What do you view then as the implications for insurance brokers? Is it with rising insurance rates over the next 6 to 12 to 18 months? I presume you think that that's generally a positive for insurance brokers?
Well, certainly you're getting a pay rate, right, without having to necessarily do more work. And I know, of course, they're doing more work because it's more difficult to place a business. But yeah, certainly, obviously, in a hardening rate environment, you're going to see commissionable income go up as the rates go up. Of course, there are offsets to that, as we all know. A good broker will try to help his or her client out by finding ways to save money, whether that's through changes in limits, et cetera, alternative strategies. But I think there's going to be a lot more work. You guys know that better than anyone. But yeah, certainly there'll be the benefit of that. I think it's very difficult for us to say, and I don't even think we're trying now to say when this hardening cycle will end. I know other people have been out trying to predict what, the COVID losses will be. And, again, we have ranges everywhere from 30 billion to 100 billion. And some of the big reinsurance groups are still sticking with those higher numbers. We're right now, and we kind of continue to look at globally what these losses have been estimated at, and they're just above 30 now. But most of those are coming through the reinsurers, right? So the primaries are not getting hit as hard with that. Again, this concept of the underwriters just don't know. Certainly we've seen several years, 2 out of the last 3, with some pretty substantial catastrophe weather-related cat losses. And there's concept of climate change, whether people believe it or not. We don't know the answer, but there certainly have been large losses coming through. And of course, the interest rate environment, who can predict that, right? We've been saying forever that interest rates are going to go up, they can't go lower, and they just keep going lower. And will they go negative? I don't know. So all these things are in play. And I think if you're a commercial line broker trying to tell your client, the hard market will end at this period, or the hardening market will end at this period, I think is a very difficult conversation to have. And it's probably best just to be honest and say there's a lot of uncertainty out there, and we just have to sit with this and figure out strategies, to save you money with that being the case.
And you have the added issue there that at a certain point, some insureds may just do with less coverage. I mean, one of the things that I know has been hinted at from our customers is that there are certain clients of theirs that have said, you know what, we'll buy X dollar amount of liability cover, and that's materially less because we can't afford some of these rate increases, particularly during COVID. So, while rates are going up, it's very conceivable that we're going to see over the longer term that exposures have actually gone down. And so therefore, it's kind of a mixed bag from the insurance broker's point of view. Any thoughts on that?
Well, I guess if you're Elon Musk, right, you just go bear. You pay it yourself, of course. Like I said, there'll be these offsets. Rates going up is helpful, but if we start to see people taking higher limits or essentially not taking as much cover, that will be an offset to obviously the prices going up. So net, I guess you're kind of even. So you're right. I mean, and again, and I see Gallagher talk about this a lot. I mean, their goal as brokers, and obviously we're looking at their quarterly analyst calls. Their goal as brokers is to do best by their clients, and that includes, in a firming market, finding ways to help people save money. Again, alternative risk transfer strategies. We'll see probably more growth in captives, as we always see, and we're starting to see that already. So all of those things certainly are in play now, but there's plenty, obviously, for a good broker to do to help solve these problems.
Well, David, thank you. As always, this has been very, very elucidative to our clients, and we really appreciate your continued participation. David Paul, Principal at ALIRT Insurance Research. Thank you very much and have a great holiday.
Thank you, Gerard. I appreciate it. You too. Take care.